what's the probable total return that an investor should anticipate for the cap-weighted S&P 500 index? And the conclusion was a range of somewhere between -1% and +7%. Midpoint of that is around 3%. What is the driving force behind that thought process and that analytics?
3% returns over the next decade? That's a sobering prediction. But here's the real question. Does it spell doom for investors or opportunity? In today's complicated world, risks are higher than ever, and some are even questioning whether it is even the right time to invest. In this video, I'm cutting through the fear-mongering headlines to show you why Warren Buffett's strategy remains bulletproof. I'll break down his views on today's market, explain why he predicts that it will only grow by 3%, and reveal what Buffett is doing that you can also do to get the most value from your investments. Before we get into the future of the S&P 500, let's set the stage first. Predictions of just a 3% return over the next decade have many questioning whether the market can still deliver long-term growth, or if it's time to rethink our strategies. History provides some perspective. The S&P 500's journey has been anything but predictable, marked by periods of explosive growth, stagnation, and recovery. After the Great Depression in 1938, a $10,000 investment grew to $81,000 in a decade with 25% annual returns, showing the market can rebound after crises. Similarly, in the post-World War II boom of 1948, the same investment grew to $62,000 at 20% annual returns, driven by economic recovery. But by 1978, economic stagnation saw returns drop to just 5%, with $10,000 growing to $16,300. And in 2008, the Great Recession delivered 0% returns, leaving investments flat for 10 years. Even during the booming tech economy of 1998, the S&P 500 posted just 3% annual returns, growing $10,000 to $13,439. Proving that high optimism doesn't always translate to high growth. The takeaway? Markets are cyclical. You can see that while some periods yield incredible returns, others bring periods of stagnation. So what does all of this mean for the next decade? Can we expect the same kind of dramatic returns? More importantly, what do experts, including Warren Buffett, have to say about the future of the current market outlook? With historical market performance in mind, it's clear that the journey ahead may not be as smooth as we'd hoped. The market's short-term volatility is inevitable, so how should we approach the future? Warren Buffett's strategy has always been one of patience. Despite the market's ups and downs, Buffett has consistently recommended investing in the S&P 500, believing that over time it will generate strong returns. In fact, Buffett famously said that if he were to bet on the future of the U.S. economy, he would bet on broad market index funds, especially the S&P 500, which encompasses a wide variety of industries. But what happens when the future looks uncertain? For instance, Buffett suggests that in today's environment, we might not see the explosive growth of the past. In fact, we could be looking at a 3% return over the next decade. That's a far cry from the 25% growth periods of the past. So how does Buffett handle this? His advice: don't panic and avoid trying to time the market. While today's risks are high, cash isn't the only safe option. Buffett often emphasizes that holding cash during uncertainty can be a strategic move, enabling you to seize opportunities when markets stabilize. Patience is key. Even with modest short-term returns, the power of compounded growth drives long-term success. Buffett's strategy remains unchanged. Focus on low-cost index funds like the S&P 500 to diversify and reduce risk. In uncertain times, Buffett himself has accumulated substantial cash reserves, upwards of $300 billion, ready to invest when valuations become attractive. This flexibility is crucial during market corrections, where undervalued opportunities emerge. While low returns may concern some investors, Buffett's approach is clear: stay the course. The market will have its ups and downs, but history shows that disciplined, long-term strategies lead to rewarding outcomes.
You know, one thing that struck me in this note as well is a 1/3 chance that you have the S&P 500 lagging inflation through 2034. What's the role of inflation here, and what is the risk that it could be higher? What if the neutral rate is higher? What kind of impact would that have on equity market returns?
Well, so you think about inflation right now, the TIPS break-evens are around 2.2%, for example. And so based on a scenario where you have a return that could be -1% annualized versus +7%, kind of there's a distribution around that, relatively normal type distribution, the part tail of the distribution would give you a prospect of a return that's less than inflation. That's not the base case, but it certainly is a scenario.
In times like these, with the world grappling with geopolitical tensions, inflation concerns, and a rapidly shifting market, Buffett's perspective on cash reserves takes on an even greater significance. Many investors are scrambling to find the best investment opportunities and end up investing in overhyped stocks. This in turn increases the market bubble, which ultimately leads to market meltdown. But Buffett's approach remains calm and calculated, especially when the risk is high. As he often puts it, cash is king. But it's not about hoarding money for the sake of it. It's about strategic flexibility. In today's complicated economic climate, Buffett knows that having cash available means being able to act quickly when the right opportunity arises. And when you hear people say that holding onto cash is a mistake, Buffett has a different viewpoint. He sees the bigger picture. While the market may rise and fall in the short term, his cash reserves give him the ability to weather storms and take advantage of long-term opportunities. In the face of uncertainty, cash isn't a liability. It's a tool for future wealth creation. So what's Buffett's secret? It's not simply about piling up cash for the sake of it. It's about understanding that the current risks outweigh the potential returns in certain situations. And this brings us back to something Buffett often stresses. The biggest mistake you can make is to ignore risk. When risk is high, it's better to be patient and wait for a better time to invest. This patience and foresight have allowed Buffett to navigate through many turbulent times, including the 2008 financial crisis. When many others were losing their heads, Buffett saw opportunity. Cash wasn't just a hedge against uncertainty, it was a strategic move to seize undervalued assets when others were panicking. And today, in the world of inflation, rising interest rates, and geopolitical instability, Buffett's strategy of holding cash may very well be more relevant than ever. As he has said before, be fearful when others are greedy, and greedy when others are fearful. This isn't just a catchy phrase, it's the core tenet of Buffett's long-term success. As much as we may want to chase the next big investment, success doesn't come from making rash decisions. It comes from making calculated, patient moves when the market is ready for them. Even in the face of market volatility, Buffett is sitting on his cash reserves and waiting for the right moment to act. He knows that market swings are inevitable, but history has shown us time and time again that those who remain disciplined and strategic come out ahead in the end. So what would Buffett do in today's environment? He is continuing to stack cash and waiting for the market to present opportunities that fit his investment criteria. In fact, in this year alone, he has sold over $200 billion worth of stock to create room for opportunities when they arise. He is sitting patiently, knowing that the most valuable investments don't come from chasing trends, but from buying into businesses with solid fundamentals at a reasonable price, no matter what the market looks like in the short term.
Well, David, I want to talk about the cross-asset nature of this call, too, because you say that it's likely that bonds are going to outperform in this environment. But reading through this call, I mean, if you're not calling for a recession here, I assume the Fed doesn't cut rates back to zero. Wouldn't this be a call for cash? Aren't cash yields going to stay relatively high and you don't have any credit or duration risk there?
Well, I mean, there's other strategies. You could look at private credit. You could look at private equity as a potential way of diversifying a portfolio. Relative to right now, the idea of treasuries, 10-year treasuries yielding 4.2%. So if you were to start today and look out with our centerpiece of our, or the central case of our forecast, something like 3%. But if you look at the distribution, look, the idea of being at the high end, there are a lot of reasons why you could be at the higher end of our range, closer to 7%. Matt identified a couple of those. you typically get around 3.5% of the constituents in the S&P 500 turnover every year. So we look out for a decade.
But here's the crucial thing to remember. Buffett doesn't shy away from investing when times are tough. In fact, he has often said that it's the best time to invest when others are fearful, and if the market corrects itself, then those cash reserves will have the upper hand. So, while a 3% return prediction might sound disappointing to many in the current environment, it may seem like returns are capped. But this is precisely when the long-term investor has an advantage. Buffett's focus on intrinsic value, not just stock price, is his North Star during uncertain times. Even if the market only provides 3% return over the next decade, his ability to spot great companies with long-term growth potential is why his strategy continues to work. So what would Buffett do with a 3% return scenario? His advice would likely be, don't panic, don't overreact to short-term predictions, and instead stay focused on buying companies with real long-term potential. If the market doesn't offer the returns we've seen in the past, so be it. Buffett would rather wait for the right opportunities than chase after the hype. While many investors get nervous about having too much cash sit idle, Buffett has often defended the idea of holding cash in a volatile market. So, with market risks higher than ever, could there be more wisdom in holding cash than most realize? Buffett has made it clear that holding cash isn't the worst thing you can do. In fact, during periods of market uncertainty, when the valuations are high and the economic outlook is unclear, holding cash is a great strategic move. His reasoning is simple. Cash provides flexibility. It gives you the ability to seize opportunities when they arise, especially if the market experiences a correction or a downturn. So that's where piling cash comes into play. While it may seem counterintuitive in an era of low interest rates, Buffett views cash as a powerful tool that allows you to wait for the right opportunities, whether it's buying undervalued companies or weathering storms when others might panic. But the key here is context. In today's complex world, with inflation rates, geopolitical instability, and unpredictable interest rates are just part of the landscape, having cash on hand isn't just a buffer, it's a strategic advantage. It's about being prepared for whatever comes next. And Buffett's track record proves that sitting on cash during uncertain times can be just as important as making investments. As Buffett famously quotes, "The market is there to serve you, not to guide you. When the time comes and price is correct, holding cash positions allows you to take advantage of the bargains others will overlook." Want to know what Howard Marks thinks about the current market conditions? And is he considering going abroad for investments over the next decade? Click the video on the screen to find out.